Welcome to the Playing Books Podcast. We constantly hear this idea, right? Work harder, hustle more, save every dime. But what if that's just not the right way to think about it? What if working harder is actually keeping you stuck?
That's exactly the kind of counterintuitive idea this book kicks off with. The strategy you pick, it matters way, way more than just how hard you work. The author, Nick Maggiulli, uses this great chess analogy to explain it.
Oh yeah, the chess thing. I thought that was brilliant. You know how amateurs just memorize openings? They're basically hoping their opponent makes a mistake, falls into some trap they learned. But a master player, like this Victor guy he talks about, they're playing a different game entirely.
Exactly right. Victor isn't just following a script. He might take a risk against one player but play it safe against another, even with the same opening moves on the board. It's all about the bigger picture, the strategy, even the person across from him. He's got a whole philosophy. Reminds me of what Andy Grove from Intel said, something like, so many people work so hard and achieve so little. If that's you, maybe the problem isn't your effort. It's the framework you're using.
Yeah. And closing that gap, aligning what you do with where you are financially, that seems to be the whole point of this book, the wealth ladder. Proven strategies for every step of your financial life. So for this podcast episode, our mission is really to unpack this system, this ladder, and figure out how you can apply the right strategies at the right time. It's not about stock tips, right? It's more like a flexible philosophy because things change. Interest rates, jobs, what we want out of life. It's always moving.
Yeah, exactly. So let's get the basics down first. The whole ladder is built on net worth. Simple concept. Assets minus liabilities, that's your number. And the ladder itself has 6 levels.
Okay, 6 levels. And they're separated by a factor of 10. That jump, that 10x, seems really important. Why specifically tenfold?
Well, the thinking is that a 10x increase in your net worth is usually the point where you can actually make a big, noticeable, permanent change in your lifestyle. Like think about going from level 2, that's up to 100 grand, to level 3, which is 100,000 up to $1 million. Hitting $100 great, gives you some breathing room, sure, but crossing that $1 million mark, that often changes your whole relationship with work, your feeling of security. It's a real shift, a psychological one.
Gotcha. Okay, so let's quickly run through the levels, just so everyone on the same page. Net worth definitions. Level 1, under $10,000. Level 2, $10 up to $100K. Level 3, play $100K to $1 million. And you said that's kind of the broad middle class in the U.S.
Yeah, statistically, that's where the bulk of U.S. households land, about 43%.
Okay. Then level 4, $1 million to $10 million. The upper middle class, maybe?
That's a good way to put it.
And then levels 5 and 6 are $10 million plus. That's the really upper tier, the super rich territory.
And when you look at the data, like from the Survey of Consumer Finances, the SCF, it shows this stark difference globally. Most people are stuck down in level 1 or 2, but in the U.S., it's shifted up. Like you said, most households are actually in level 3.
Which leads to that weird paradox, right? The people in level 4, the millionaires with maybe 2, 3, 5 million, they're often the ones saying, I don't feel rich.
And the latter helps explain why. The image we get from media, the private jets, multiple mansions, fancy cars, that's not level 4 living, that kind of lifestyle. That takes level 5 or level 6 money. 10 million plus, easy. If you're in level 4, yeah, you've got maybe travel freedom, you can upgrade your flights, take nicer vacations. But you're not living like the top 0.1%. Their whole comparison point is skewed. They look at someone with $50 million and think, okay, they're rich, I'm not. It's all relative, and that causes a lot of anxiety, even for people who are objectively doing very well.
Okay, that makes sense. Sets the stage nicely. So let's dig into the strategies now. Why is the advice so different depending on your level? Why can't you just give everyone the same tips?
Because the goalposts move. Giving someone in level 1 advice about tax loss harvesting or something, it's pointless. It's like the book says, giving an elite athlete's diet plan to someone who's severely overweight. You start with the fundamentals first. For finance, the fundamental strategy has to change based on your net worth. And the first big area where this really shows up is spending.
Ah, right. This is where that 0.01% rule comes in, the 0.01% rule. Trying to put a number on what's truly trivial spending. How does that work day to day?
So the 0.01% rule is basically the amount you can spend over your usual income each day without really impacting your wealth level. It's literally 110,000th of your net worth. It's meant to answer that question, okay? At my level, how much of a price difference really doesn't matter.
Okay, let's make that concrete. Run some numbers.
Sure. So say you're just starting level 2, maybe $10,000 net worth. 0.01% of that is $1. Just $1 a day. That means you've basically achieved grocery freedom, right? spending an extra buck on cage-free eggs versus regular, trivial, don't sweat it. But choosing between a $15 lunch and a $30 lunch, that $15 difference is still a big deal relative to your $1 daily trivial amount. Now, jump to the start of level 3. You've got $100,000 net worth. Your 0.01% is now $10 a day. Suddenly, that $10 difference on the lunch menu, it is trivial. You've hit restaurant freedom. You don't need to agonize over that price difference anymore.
So it scales up, but based on your wealth, not just your paycheck that week. Okay, but what about the classic problem? The high earner, big salary, but maybe zero savings. They feel rich, but their net worth is low.
That's the trap, the absolute killer. Spending based on income, not wealth. You see it all the time, right? Pro athletes, maybe some highly paid execs. Huge income for a few years. They start spending like they'll earn that forever, but their net worth, still tiny. Then the income stops, maybe the career ends, and bang, they're broke. The lifestyle is built on sand. The author puts it bluntly, something like, the most expensive thing some people own is their ego, and it bankrupts them.
Ouch. True, though. So if we're using this rule to guide spending, the book adds a really important safety layer. Use your liquid net worth. Why is that distinction so critical?
Liquidity. Yeah, it's all about safety, about practicality. Let's use that level 4 example. Say you technically have $1.1 million net worth. Okay, great. But wait, maybe $600,000 of that is tied up in your house equity. Another $250,000 is in your 401k or retirement accounts. What can you actually get your hands on easily, quickly? Your liquid stuff bank accounts, brokerage account, maybe it's only $250,000.
So even though on paper you're a level 4 millionaire, for day-to-day spending decisions, you should act more like someone in level 3 based on that $250 liquid number.
Exactly. You can't just sell a chunk of your house to buy a new car or fund a trip. Well, not easily or quickly anyway. So you need to be conservative. Use the liquid number for that 0.01% calculation. It stops you from making spending decisions based on paper wealth that could cause real cash flow problems if something goes wrong. It keeps the rule grounded.
Okay, that makes sense. Now let's drop right down to the bottom rung, level 1. Less than $10,000 net worth. The strategy here sounds like, well, survival.
Yeah.
Stabilization. Because here, bad luck isn't just an inconvenience, right? A car repair, getting sick, losing a job, it could be a total disaster.
It's amplified massively, and this is something a lot of financial advice just glosses over. The problem in level 1 usually isn't people blowing money on fancy stuff. The data shows the lowest 20% of earners spend more than 100% of their after-tax income just on basics. Housing, food, transport, healthcare. They're already behind just trying to live. So the issue isn't spending, it's income. The absolute priority has to be stopping the bleeding, especially from high-interest debt, taking what the book calls atypical action.
Right, stop digging the hole deeper. And the first thing to tackle has to be that crippling debt, the 18%, 20% credit cards.
Absolutely. Warren Buffett said it best, you can't make progress borrowing money at 18 or 20%. If you can't make that work, nobody can. So level 1 is about getting rid of that toxic debt and then finding ways to boost income. Maybe skills training, but ideally without taking on more expensive debt like student loans if possible.
But the book brings in something else here, something often missed in standard finance talk. Social wealth. What does that mean in this context?
Yeah, this is a really important human element. We usually think of wealth as money, right? Assets. But the author references work by Ruby Payne, who points out that in situations of poverty, people are possessions. There's this deep reliance on each other. That network. A friend watching your kids, family helping with a loan without charging crazy interest, having a couch to crash on if you lose your place. That is a form of wealth. It might not show up on a balance sheet, but it's the safety net that often allows people to take those necessary atypical actions to even get to level 2. It's crucial.
Okay, so let's say you've managed that. You've climbed out of the hole, maybe paid off the bad debt, got a little cushion. You're in level 2, $10,000 to $100,000 net worth. The strategy totally shifts now, doesn't it? Away from just survival and towards education and leverage. The focus becomes learn today, earn forever.
Exactly. Level 2 is like the sweet spot for investing in yourself. You actually have a bit of money, maybe enough for a course or a certification, but you don't have so much wealth yet that the potential payoff from boosting your skills feels insignificant. The story of the Polgar sisters is a great illustration. They became chess grandmasters not because they were born geniuses, but through intense, focused training from a young age. It shows the power of deliberate skill building. And your education, your skills, that's leverage. It pays dividends for your entire career, and importantly, no one can take it away from you in a market crash or a lawsuit.
Right, it's probably the highest ROI activity at this stage. But how do you choose which skills to learn? There are so many options.
Well, the book offers a guideline here too, the 1% rule for earning decisions. It's pretty simple. If taking some action, getting a certificate, learning a specific software, whatever, has a decent chance of increasing your net worth by at least 1%, you should strongly consider doing it. So if you're at $10 grow net worth, you're looking for things that could add $100. If you're closer to $100, you're aiming for things that add $1,000 or more, either through higher pay or maybe lower future costs. It helps cut through the noise and focus your energy on things with a real measurable potential impact.
Keeps you focused. Okay? And thinking longer term, career-wise. The usual advice is that Venn diagram, right? What you're good at, what you love, and what pays well.
Right, the trifecta. But the book, maybe channeling people like Scott Galloway, offers a slightly different take. It suggests maybe prioritizing what people will pay for first. It kind of flips the follow your passion script. Why? Because often interest and passion actually follow mastery. If you pick a skill, the market clearly values could be data science, could be a skilled trade, could be effective sales, and you get really good at it. The success, the money, the respect, that feeling of competence, that often creates the passion you were looking for in the first place.
Huh. That's a really interesting reframing. Don't wait for lightning to strike. Find something valuable, master it. And the passion might just grow from the success itself.
Precisely. And you want to do this heavy lifting early on. Sam Altman talks about this, the compounding effect of working hard and smart when you're young. You build skills faster, grow your network, gain experience. That early momentum gives you leverage for decades. The effort you put in from, say, 22 to 32 pays dividends for the next 40 years.
Makes sense. Okay, let's climb higher. Level 3. $100,000 to $1 million. We're solidly middle class now. The strategy shifts again, right? Less about foundational skills, more about putting money to work. Career moves and side hustles should be adding, what, $1,000 to $10,000 consistently.
Yeah, the mindset here becomes just keep buying. This is where you absolutely have to start prioritizing investing in income-producing assets. If you look at how wealth is held, levels 1 and 2 are often mostly cash, maybe a car, basic stuff. Level 3 might add a primary home. But to break through level 3 and reach level 4, you need to shift hard towards owning things that generate income or grow in value stocks, bonds, maybe rental properties, small business stakes. You have to transition from being primarily a consumer to being an owner.
And level 3 is where compounding really starts to show its magic, which makes starting early and being consistent just critical. The numbers on this were kind of shocking.
They really are. If you save consistently for, say, 40 years, the money you put in during just the first 10 years ends up being responsible for more than half of your final portfolio value. It's not because those early contributions were the biggest ones, it's just because they had the longest time to grow and compound. Starting early in level 3 basically locks in decades of that exponential growth.
So those side hustles people talk about, they're not just for extra spending money at this level.
Yeah.
They're fuel for the compounding engine. The book had some pretty wild examples of side hustles that turned into real businesses.
Oh, yeah, totally. Like the Kent Island Express, driving people over that huge, scary bridge in Maryland because they were too afraid to do it themselves. Super niche problem, right? But they identified it, offered a solution, and built a real business out of it. Paid well, too. And then there's the classic, almost unbelievable one, Twiggy the water skiing squirrel.
Yes. Twiggy!
Started as basically a pet project, right? Train a rescued squirrel to water ski behind a little remote-controlled boat. Sounds nuts. But it turned into a touring show, merchandise, the whole deal. Supported the family for years. The lesson isn't about needing some super complex idea. It's about finding any demand, even a quirky one, and figuring out how to meet it and leverage it.
But level 3, it's also dangerous territory, isn't it? The book calls it the level most likely to see people fall back down, mostly because of lifestyle creep.
Yeah, that's the big anchor holding people back. The PSID data panel study of income dynamics shows it clearly. Households that slipped from level 3 back down to level 2 over a decade. They were spending about 59% of their pre-tax income each year. Compare that to households who stayed in level 3. They spent only 49%. Often the ones staying put actually earned a bit less, but crucially, they kept their spending under control. They didn't let their lifestyle inflate as much.
And it seems like one particular area drives a lot of that overspending. Housing.
Spot on. For homeowners in level 3, something like 65% of their total assets, on average, is locked up in their primary home. Now, a house can be a great asset long-term, sure, but if you upgrade too big, too soon, or spend too much on renovations, it stops being just an investment and becomes a major consumption item. High property taxes, insurance, maintenance, it just eats up cash flow. Cash that should be going into those income-producing assets we talked about, it becomes a drag.
That's a critical point. Owning a home is the dream, but if the cost of that dream prevents you from actually building other wealth, it's working against you on the ladder. You have to choose maximum lifestyle now or maximum investment for later.
And for level 3, if the goal is to keep climbing, the choice has to be prioritizing investment.
Okay, let's tackle the big jump, level 4. $1 million to $10 million. The wealth plateau. This is where a lot of successful, high-earning people seem to get stuck. Mathematically, this is where things really flip, right? Your investments start earning more than you're saving from your job.
Yeah, let's paint that picture. Say you're a skilled professional, making good money, maybe $250K a year. After taxes, living costs, you manage to save, say, $85,000. Pretty good. But now, let's say you've already built up a $2 million investment portfolio. Even a modest 5% return on that is $100,000 a year. Boom. For the first time, your money is actually working harder than you are in terms of adding to your net worth. Your capital is out-earning your labor savings.
That sounds great. So what's the problem? Why is this a plateau?
The problem is that the strategies that got you to level 4, working hard, high salary, consistent saving and investing, they lose their punch here. They're not enough to get you through level 4 to level 5. Think about it. Even if that household somehow managed to save a whopping $200,000 a year every single year, even with the 5% return compounding, it would still take them 21 years just to hit the $10 million mark for level 5.
21 more years after already reaching millionaire status.
Wow. Yeah. And remember, the median age for hitting level 4 is around 62. Most people just don't have another 2 decades of peak earning potential or the desire to grind that hard for that long. The math just doesn't work with traditional methods anymore.
Which brings us back to that feeling. The quote from Succession, right? Cousin Greg thinks $5 million is the dream, but Connor Roy bursts his bubble. $5 million is a nightmare. The poorest rich person in America. You have enough to be comfortable, maybe, but not enough for that next level of freedom or impact.
Exactly. Going from $4 million to $5 million, it doesn't really change your daily life or spending power in a huge way. It just highlights that you need a totally different approach now. The mental framework has to shift. What got you here won't get you there. Diligent saving from a salary got you to $1 million. It won't get you to $10 million. Not realistically, anyway.
Okay, so if saving more isn't the answer, what is the key? What's the new strategy needed to make that leap to level 5?
It comes down to one word: equity. Getting significant ownership in a business, either starting your own or getting a meaningful stake in a fast-growing private company early on. That is the single biggest factor separating level 4 earners from level 5 and 6 wealth holders. The data is overwhelming. Something like 63% of the wealthiest households got there primarily through their own business or early equity in one.
So it's not about saving an extra $50 from your bonus. It's about positioning yourself for a multi-million-dollar event, like selling a company or having valuable stock options. What does significant equity look like?
It means owning enough of a percentage, could be 5%, could be 50%, depends on the company's potential value, so that when there's an exit, like an acquisition or an IPO, your payout is measured in millions. You're shifting focus entirely away from earned income, salary, towards capital income ownership. This could be anything from building a software company to buying and scaling up an existing small business, or maybe larger scale real estate development. Something with the potential for a big valuation multiple and a massive payout.
Okay, so that leads us into the higher levels. Level 5, $10 million to $100 million. This sounds like scaling up that equity strategy from level 4, but maybe with more paranoia. The framework is only the paranoid survive.
Yeah, paranoia in a strategic sense. And success here often isn't about hitting one grand slam. It's about iteration, learning from attempts. Look at Mark Cuban. His first big win was selling a software company for $6 million. Great level 4 success. But that didn't make him a billionaire. Elon Musk with Zip2 netted him around $20 million. Again, fantastic, but not the end game. It's often the next venture, built using the capital and the lessons from the first win, that really catapults people into level 5 or higher. The data backs this up. Entrepreneurs who've sold companies before tend to build much bigger businesses the next time around. Experience compounds too.
And the size of that business you build or own becomes critical for the final payday, right? Bigger is better for valuation.
Absolutely. There's a real valuation premium for scale and simplicity. Imagine one well-run company making $10 million in profit. It might sell for a 10x multiple $100 million valuation. Now imagine 10 smaller separate companies that also add up to $10 million in profit. They might only sell for an 8x multiple collectively. Why? Because integrating 10 small, messy businesses is a headache for the buyer. It's riskier, less efficient. So investors pay more for the single, scalable, proven entity. Growing and streamlining for that higher multiple is key in level 5.
But here's the paradox. The very thing that likely got you into level 5, concentrating all your effort and maybe wealth into that one successful business, becomes the biggest threat once you're there.
That's the danger. Over-concentration. It's the #1 destroyer of wealth at these upper levels. The classic example is Sean Quinn in Ireland. Huge fortune, but nearly all tied up in one company and some related risky stock bets. Wiped out. Once you have that big exit, that liquidity event, you have to diversify. Concentration builds the wealth initially, but diversification protects it and keeps you in level 5 long term.
Okay, finally, the peak. Level 6, $100 million plus. What really changes when you hit that kind of number? Is it just more?
In terms of what you can actually buy or consume day to day, surprisingly little changes compared to level 5. You could already afford pretty much anything tangible you wanted. The focus at level 6 shifts almost entirely away from accumulation and towards two things: protection and legacy. The wealth is so vast now, the main concern isn't making more. It's preventing catastrophic loss and thinking about the impact you want to leave behind. Think Alfred Nobel creating the Nobel Prizes, totally redefining his legacy after a mistaken obituary painted him negatively.
And the biggest risks aren't really market crashes anymore, are they? They're more personal, behavioral.
Exactly. You've got teams of experts managing the financial risks. The real dangers now are internal or interpersonal. Divorce is a huge one, lawsuits, and maybe the most insidious. That psychological drive for more, leading to unnecessary risks. Morgan Housel pointed out how many top billionaires have been divorced. A divorce lawyer quoted in the book basically says, wealth just magnifies existing relationship problems, people not knowing what they want or not being able to communicate it.
And that relentless need for more, even when you're already at the top, can be incredibly destructive.
The story of Roy Raymond, the Victoria's Secret founder, is just tragic, right? Sold the company relatively early, made a fortune by any normal standard, then lost it on a new venture and ended his life. He was objectively incredibly wealthy at one point, top tiny fraction of a percent. But it wasn't enough to satisfy that internal drive. Even Charlie Munger, supposedly, wished late in life he had trillions instead of billions. It shows how wealth itself can warp your perspective, create this permanent sense of not quite enough no matter how high you climb. Relative deprivation is powerful.
Which makes this next part of the book's framework so incredibly important. Stepping back and asking, what does money actually buy? Does it buy happiness?
The $1 million question, or maybe the $100 million question at this point. The book leans on the latest research, reconciling some earlier conflicting studies by people like Kahneman and Killingsworth. And the answer is nuanced. It's logarithmic.
Okay, logarithmic happiness. Break that down for us. What does that mean practically?
Think of it like this. Going from earning, say, $20,000 a year to $50,000 a year, that makes a huge difference in your day-to-day happiness. Why? Because it solves real pressing problems worrying about rent, food, basic security. The happiness curve goes up steeply. But going from earning $1 million a year to $10 million a year, the impact on daily happiness is much, much smaller. Barely noticeable, according to the research. The curve flattens out dramatically. So money buys a ton of happiness for people who don't have money, but very little extra happiness for people who already have a lot.
And the crucial finding seems to be that money primarily makes you happier if you're already reasonably happy. If you're miserable, struggling with purpose, health, relationships, more money probably won't fix the core issue.
Which leads right into that fantastic analogy the author uses. Money is like salt. It's the great enhancer. Salt doesn't magically create flavor, right? It brings out the flavors that are already there. If you have a delicious, well-prepared meal, salt makes it even better. But if you start with a pile of garbage, adding salt just gives you salty garbage. Multiplying 0 by anything is still 0. Money can enhance misery too, funding addictions, enabling behaviors that push people away. But crucially, it can enhance joy, maybe by buying you back time or enabling experiences that strengthen relationships.
So if money is just the salt, we need to work on the underlying meal, the other things that make life rich. The book details 4 key types of non-financial wealth alongside the financial piece. Let's touch on those. Social wealth first.
Right, social wealth. This is all about the quality of your connections, not how many LinkedIn contacts you have. Research suggests having just, say, 4 really close supportive friends can be incredibly protective against loneliness and stress, and the value is immense. Being in a happy, stable marriage, for example, has been equated to something like an extra $100,000 a year in terms of well-being compared to being alone. That's a huge non-financial return.
Wow. Okay, next up, physical wealth. The greatest wealth is health. We all know it, but how does it fit here?
The numbers are staggering. Good physical health is estimated to be worth the equivalent of an extra $400,000 a year in well-being. That is enormous. It's 4 times bigger than the marriage benefit we just mentioned. It dwarfs almost every other non-monetary factor studied. So taking care of your health isn't just a nice to have. It should be a top priority from level 1 all the way up.
400K in well-being equivalent. That's unbelievable. So what are the key levers for physical wealth? What should people focus on?
The book highlights 2 big measurable areas: strength and cardiovascular fitness, often measured by something called VO2 max. VO2 max is basically how well your body uses oxygen endurance, stamina. Improving it has huge longevity benefits. And for strength, there was that amazing study on firefighters. The ones who could do over 40 push-ups had something like a 96% lower risk of heart problems over the next decade compared to guys who could only do less than 10.
Wow, 40 push-ups. That's concrete, actionable, something most people could work towards regardless of their bank account.
Totally. And just improving your VO2 max from being in the bottom quarter to the average range cuts your risk of dying from any cause by like 50%. These are massive health returns on relatively simple, consistent effort. It's the ultimate investment.
Which ties into mental wealth, right?
Yeah.
Our psychological state, resilience, finding meaning.
Exactly. Mental wealth is about managing stress, but also critically about having a sense of purpose. The book quotes Richard Nixon, of all people, saying the unhappiest folks he knew were wealthy retirees with nothing to do. The goal isn't just to stop working. It's often finding different work, maybe part-time, maybe volunteering, something that feels meaningful after the main career ends. The happiest retirees stay engaged.
And it's about choosing your status game carefully, isn't it? Not just chasing external validation.
Yes. You have to define success on your own terms. A scientist's status comes from discoveries, and athletes from performance. If you're in level 3 financially but constantly compare yourself to level 6 billionaires, you're setting yourself up for misery. That's terrible for mental wealth. Finding what truly matters to you, independent of the dollar amount, is key.
Okay, and the last one, time wealth. The ability to control and use your time intentionally.
This is often the ultimate payoff people are seeking when they climb the financial ladder. And yes, generally, people in developed countries have more leisure time than generations past. But as the philosopher Seneca said way back when, it's not that life is short, it's that we waste so much of it. The danger, especially in retirement, is having all this free time but no structure or purpose, just falling into space, as the book puts it. True time wealth isn't just empty hours. It's having the control to dedicate your time to things that build your other forms of wealth: relationships, health, learning, purpose. You need to design how you'll use the time your financial wealth buys you.
It all comes together. And the author's own story seems like a perfect illustration of applying these ladder principles. He started down in level 2, right? Working class background.
Yeah, parents had gone through bankruptcy. His climb really demonstrates the strategies in action. First big move. Level 2 strategy. Leverage education. Focused hard in college, got internships that led directly to a high-paying job in finance consulting. That job provided the income engine to quickly hit the first major milestone, Charlie Munger's proverbial first $100,000, getting him solidly into level 3. He did it by working hard, yes, but specifically by acquiring valuable skills: data analysis, coding, learn today, earn forever.
But then he hit that level 4 realization, didn't he? That the high-paying job, while great, was ultimately trading time for money. It wouldn't get him to the really high levels on its own.
Yeah.
That led to the side hustle.
Exactly. Starting the blog of Dollars and Data back in 2017, that was essentially him applying a level 4 strategy, building an equity asset, even while his net worth was likely still in level 3. That blog post each week, that created something that could earn money passively, separate his income from his time. It was the combination, a high-income job plus the scalable content business, that propelled him into level 4 relatively young, by age 34.
He's also pretty open about luck playing a role. That story about waiting just a few extra minutes for a professor who then connected him to that key internship.
Right. Luck definitely plays a part in everyone's story, can't deny it. But the key takeaway is less about the luck itself and more about being prepared to capitalize on lucky breaks when they happen. As the author notes, most of us aren't going to be the next Musk or Bezos, but his path, combining a good job with some kind of side business that builds equity, that's a much more achievable template for many people if they apply the right strategy for their level.
We should temper expectations a bit, though. He reached level 4 by 34, which is fast. The median age for a U.S. household hitting level 4 is 62. This is usually a long game.
Absolutely critical point. Patience is key. The data, that PSID data, again, shows that while moving up is possible, especially from level 2 to level 3, most households, about 63% actually stay in the same wealth level over a typical decade. So the goal shouldn't necessarily be hyperspeed ascent. It's more about steady progress, making the right strategic moves for where you are now, and importantly, enjoying the journey along the way.
Which circles back to that final, maybe most profound lesson from the book,
Yeah.
the relativity of money. After climbing the ladder himself, the author's perspective shifted, didn't it? From scarcity to seeing money more as just a tool.
Yeah, it's almost ironic. You often only gain that perspective after you've gone through the climb. Like the psychologist Daniel Levinson observed, we have to make huge life choices early on before we really have the wisdom to make them well. It's only later, looking back, that you might fully realize, as the book concludes, that a wealthy life isn't a number, it's a feeling.
So the ultimate message for you, listening right now, isn't just about maximizing the number in your bank account that's the easy part to measure. It's about consciously building those other forms of wealth. Your health, your relationships, your sense of purpose, because those are the things the money is meant to enhance.
Exactly. Make your financial wealth the salt. Let it enhance a life that's already rich in other ways. If you focus on building that foundation now, then wherever you are on the wealth ladder and however fast or slow you climb, the journey will actually lead to a truly wealthy life, not just a big bank balance.
Well, this has been fascinating. We really hope this to look into the wealth ladder. Proven Strategies for Every Step of Your Financial Life by Nick Maggiulli has given you some new ways to think about your own financial strategy. Maybe challenge where you are on the ladder and whether your actions align with that level. We definitely encourage you to check out the book for all the details we couldn't cover. It's packed with data and practical advice.
Yeah, grab a copy if this resonated, and maybe engage with the author, Nick Maggiulli, on social media too. He's very active and shares great insights regularly. Let these ideas really sink in and see how they might enhance your own path.
Absolutely. Think about how these concepts apply to your life. What's one small strategic shift you could make based on your current level? Thank you so much for tuning into the Playing Books podcast for this episode. If you found this valuable, please consider following or subscribing wherever you get your podcasts.
And maybe share it with a friend who might also be thinking about their financial journey. We appreciate you listening.